Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Christy Aguilian, Director on BlackRock's iShares Investment Strategy team. We're talking about the market outlook and some investing strategies for the second half of 2023. BlackRock, as we know, is the world's largest asset manager. They offer more than 400 US-listed iShares ETFs. Christy, welcome. Thanks so much for coming back on the show.
Thanks so much for having me, Nina. Looking forward to the conversation.
Sure. So, most experts had predicted a rough first half for stocks and a recovery in the second half of 2023, but stocks just posted a tremendous first half. In fact, it was the Nasdaq's best half-year performance in 40 years. And I saw the investment guide put out by BlackRock, and you and your team expect the second half of 2023 to be driven by three main narratives. Let's talk about them.
Yeah, definitely. So I think, to your point, the first half of this year really surprised a lot of investors by just how well risk assets did. I think that, our view is maybe a little bit more cautious into the second half, but, as you mentioned, the themes that we're thinking about here and kind of what we view investment returns as being really driven by for the second half, we kind of phrase as the three Ps, if you will. So we're thinking about kind of a Fed pause, if and when we get it, and really how long that may last for. I think our expectation is that the Fed is going to need to hold interest rates higher for longer. The second one is really corporate profitability is the second P that we're thinking about there. So we're really looking for opportunities, specifically within equity markets, where we think that those are priced appropriately and taking into account some of the risks that we may see in the second half of the year. And then lastly, just sort of that growing importance and the role of fixed income in portfolio construction. So the final P there was the portfolio part. And really that's just, using the tools that we have available to us and thinking about ways that we can use fixed income and, maybe fixed income ETFs in particular to do a lot of the heavy lifting in the second half of this year. So we really like the income on offer there and see a lot of opportunities within that asset class.
Very interesting piece, Fed pause, corporate profitability, and portfolio positioning. So let's talk about them because these are big questions for investors. Most investors are wondering what the rest of 2023 will bring, whether the Fed will resume interest rate increases because this inflation remains stubborn. We know that. So tell us what investors can expect from the second half in terms of equity and fixed income performance.
Yeah, big question. Lots to unpack there. So, I think one of our kind of core tenets with what we just published in the Midyear Outlook is really that it's too soon to tell in terms of the question of recession, right? I think if we look at the first half of 2023, we've kind of seen these two opposing narratives, if you will, right? And there's each one of these camps, either the recessionary camp or the soft landing camp, both have different data to support those claims, right? So in the recessionary camp, we've really seen manufacturing slow down quite a bit. We've seen, credit conditions that have tightened substantially since the banking turmoil that we saw in March. And then we've seen excess savings rates have fallen. So all of those things point to, there may be more risk ahead. I think in the soft landing, camp and that end of the spectrum in terms of how investors have thought about the first half of the year, obviously we have a labor market that just remains incredibly robust. Even, so far in July, since we published this at the end of June, we've seen, continued high prints in terms of the labor market, surprising to the upside. So unemployment staying near, all-time lows. We've seen inflation moderate a bit, and that has come down certainly. But we do think that that's going to continue to be a little bit stickier than maybe the market currently expects. So I think that the most important thing to think about right now isn't necessarily just are we or are we not going to get a recession in the second half of the year? It's how to construct a portfolio that is maybe better able to weather either of those scenarios. We think that the distribution of risks is fairly wide. And I think importantly, what we've seen too is, in our view, maybe the soft landing scenario is priced in more to the equity markets than the potential for a recession. We still think that those risks are fairly balanced. We go back to this idea that it's probably too soon to tell whether we can call the all clear for the economy or not yet. And so we like setting up a portfolio so that it's sort of well positioned to perform in a variety of different outcomes as opposed to being overly geared towards one or the other. So I think that's kind of the important, high level takeaway of how we're thinking about second half of the year and the economy. And obviously that can translate into different investment products and different preferences within asset classes as well.
Right. So this has been the most talked about, most anticipated recession in history, and it just keeps getting pushed out. So it is better for investors not to, predict whether whether the recession is going to happen, or we can avoid a recession, but it's better to focus on portfolio positioning. And in the guide, I read that BlackRock believes that investors should be nimble with their asset allocation, and they should be willing to adjust their portfolios based on evolving macroeconomic data. And you lay out 3 themes that could work in the second half. So let's take them one at a time. The first one is holding tight. Tell us about it.
Yeah, definitely. So yeah, if we think about the 3 themes and how to invest in this very uncertain macroeconomic environment, one of the things that we do believe is that the Fed is going to have a very difficult time cutting interest rates anytime soon. So holding tight really does just apply to kind of central bank policy, I should say globally, and not just the Federal Reserve. But we do think that higher for longer interest rate regime that we think we're going to be in for at least the rest of this year, that really does support allocations into high quality fixed income. So at the very highest kind of broad asset allocation level, we do still have a preference for fixed income over equities. And specifically within fixed income, I think that right now the conversations that we're having are more about extending duration. So the kind of the most important takeaway within the fixed income sleeve of a portfolio is to step out of cash. And that's kind of what we've written about and what we see. So we've looked at a variety of different types of environments and potential outcomes for what could happen. And we really like kind of that 3 to 7 year part of the curve. We like that intermediate duration profile. And one of the reasons why we like that is just because coupons are so high right now that you have enough carry that it can provide sort of a buffer, even if interest rates do move higher. So, I know we've talked a bit about whether this is a pause from the Fed or whether this is a skip from the Fed, where we may, most likely probably get interest rate hikes again in July and or August. But really, I think that we're looking at it from the position of where carry is right now in fixed income, and specifically kind of going back to that intermediate, let's call it the ag sort of exposure in the intermediate part of the curve. There's enough cushion there from the coupon that you're getting that you're really a bit more resilient to, even if rates go up further from here, you can still generate a positive return. And if in fact rates go down, which we don't think is going to happen anytime soon, you can really generate a positive return. So we think it's time to think about, extending duration a little bit, using that higher yield and that higher carry as a buffer against moves in interest rates. And then really just as once again, we're seeing that be a little bit more ballast within the portfolio. We've seen stock bond correlation go negative, which has been really helpful, or can be helpful if we think that equities may have a challenging time in the second half of the year. So we're thinking about, that exposure using a ticker like AGG is pretty simple and straightforward. It's, one of the lowest fee products on the market, but we think that that's like the right exposure for right now and where we see opportunity within fixed income and that holding tight theme.
Very interesting ideas, because we know a lot of money has gone into cash, money market funds, more than $600 billion, I think. And let's see if investors will finally step out of cash, and extending duration makes a lot of sense in this environment. You also talk about high quality dividend paying companies. Could you expand a little bit on those kind of investments, why they make sense in the current environment?
Yeah, absolutely. So, as I mentioned, at the top, I think we do still have a preference for fixed income at the very broad asset allocation level. But one of the most interesting questions and conversations I would say that we're having with investors right now is just, what do I do with the equity sleeve of my portfolio? I think that's the more complicated question right now. I think lots of investors are seeing the opportunity and have in fact acted on the opportunity in fixed income. But on the equity side, it's just a lot more complicated, right? So, we think that we've seen valuations turn a little bit rich, most likely. We've seen earnings per share kind of forward estimates for the S&P 500 have jumped even fairly substantially since the first quarter. So we really do see this optimism that's priced into where equities are trading right now in the US that we think is maybe a little bit ahead of itself. So again, not to say that we necessarily are calling for a recession, and probably not a deep recession, even if we see one. But that being said, that if we do see a mild slowdown, that also probably makes the case for a mild recovery. So we're not expecting a big, V-shaped pop in the equity market like we may have seen in previous drawdowns. So we kind of think that the near-term upside for equity markets feels a little bit capped. We don't see a huge amount of near-term upside, and we think that the downside risks might be a little bit underappreciated in the market at this moment. So that causes us to be a bit more defensive in our equity positioning and our preferences, as you mentioned. I think that the idea of dividend paying funds, and particularly we like dividend growth strategies. So we see companies kind of with this history of being able to consistently grow their dividends over time. One of the important things that we like about that is that implies financial strength, and it implies discipline, right? So I think that when you think about those are really quality types of characteristics. Dividend paying stocks tend to have a higher free cash flow yield. They have lower leverage compared to other companies. So we like kind of waiting out in those types of exposures when there's a lot of uncertainty, by gravitating towards the companies that maybe have the highest amount of financial strength to be able to weather whatever that looks like. In addition to dividend paying funds, we also just like a quality screen more broadly. So for those who are kind of looking to reduce a little bit of risk on the equity side of a portfolio, something like a QUAL, which is our quality ETF, is a nice way to do so. We see opportunity in those quality tilted kind of growth type of stocks. And then, lastly, the third strategy we have is really for somebody who wants to reduce their risk quite a bit. And we think about that as like a minimum volatility strategy. So yes, you give up a little bit of the upside capture if the market does move higher, but you reduce the overall volatility in the index. And something like that has worked really quite well in similar environments. If we think about last year when we had, higher inflation and continuing monetary policy tightening, we saw the minimum volatility index outperform its market cap weighted version. So again, I think that the best way to kind of summarize our equity views right now is to stay invested, to get more defensive, and to really kind of camp out in those stocks and those indices that maybe screen for or identify companies that have really quality earnings and quality balance sheets that should really be able to weather what's coming better.
I like those ideas. In fact, quality has outperformed the broader market in previous challenging macroeconomic environments. And your ETF that you mentioned, QUAL, QUAL, has been very popular with investors this year, has gathered a lot of inflows this year. And in full disclosure, I own QUAL as well as DGRO in the ETF investor portfolio that I manage. USMV, which is the minimum volatility ETF, that is also very interesting. Now let's talk about the third theme, which is really interesting because it talks about the mega forces. And we know that generative AI has captured investors' imagination this year, and it is a real technology, right? It is poised to revolutionize the way we work, and that could lead to a new level of productivity. But there are many other structural changes that are already underway, and that will have a major impact on corporate profitability. And it is very important for investors to identify those catalysts and the likely beneficiaries. So talk to us about the mega forces and how investors can invest in those potential opportunities.
Yeah, absolutely. I know this is one of the more fun the topics of conversation I think that we have, because we get to sort of unleash the imagination over a much longer time horizon, right? So it's not necessarily just talking about investments from the next 3 months or 6 months, but this is almost the superstructural allocations within a portfolio. So we're calling it mega forces, mega soon. Which is, I think, an interesting dichotomy between both the long-term nature of a lot of these forces and how we think that they're going to shape the economy and shape the financial markets, but also just the fact that we're really starting to see some of those impacts today. A lot of things that we thought was maybe 5 or 10 years off on the horizon in terms of it being an investment thesis, as opposed to just sort of an idea that should shape the economy, is really interesting. So you mentioned one of them. I know we've been talking a bit about AI and generative AI in particular. I do think that, and we do believe that it has the potential to really impact many different industries. I know that right now the investment thesis behind it has been relatively narrow, and really kind of concentrated in just a handful of stocks that maybe own the large language models, or that are developing some of the technology through which we interface with the AI. But I think that, in our view, we do see that expanding out and not just being something that's captured by technology companies, but really has a potential to revolutionize industries beyond that as well. So, creating new art forms or really improving healthcare outcomes, I think are all ways we think about that. When we think about the way that we actually translate that to an investment and what that means in a portfolio, the tack that we typically take, and the way a lot of our funds are structured, is that instead of just focusing on kind of a few small handful of companies, when we think about a more long-term application to some of these mega forces, we think about an approach that really accesses kind of all of the value parts, or all of the parts of the value chain, if you will. So we may think about things like tool developers and data services, and all the way through to kind of robotic manufacturing, for example, within that AI theme. And so those can be found in ETFs as well, to kind of broaden out your exposure to a theme, as opposed to just having it narrowly focused in just a handful of stocks or ideas even. And then the other one that we write about in our paper too is really just a thought just around globalization, and in particular that how the demographic challenge of aging populations is hitting different parts of the globe. And so, we see that over the next few decades, the working population as a share of kind of the total population is projected to fall really dramatically in many developed markets, but is still pretty robust and stronger in some of the emerging markets. So we do see an opportunity in emerging markets right now, both on the equity and the fixed income side. One driven by this mega force of demographic change and how that's changing the economy of those regions, but also just some of the more standard macro impulses that we've seen, and that can be sort of a tailwind for emerging markets. We think we've probably seen a local peak in the US dollar. And we also see more opportunity for some EM central banks to begin cutting interest rates sooner than we see in the developed markets. So that's kind of a combination of both mega forces and traditional macro forces that we think can be, again, a tailwind for those regions.
Very interesting ideas. Now let's switch gears a little bit and talk about ETF flows, which I know you track very closely. And we have seen some very interesting trends there as well. And overall, US listed ETFs gathered about a little more than $200 billion in the first half of 2023. But earlier this year, we saw very weak inflows into equity ETFs, which was very surprising given the excellent performance of stocks and equity ETFs. But we saw no performance chasing, no enthusiasm for equity ETF, though the trend changed a little bit in June. Fixed income ETFs, particularly treasury ETFs, those safer ones, they saw some decent inflows this year. So tell us about your takeaways from ETF flows this year.
Yeah, it's certainly been it's been an interesting kind of wild ride, right? I think we came into this year expecting that this would be the year of fixed income ETFs, and to a large extent, it really has been. But we have started to see that revert. And as you mentioned, June was a little bit of a turning point, and I think we saw that in the flows as well. So the first kind of 4.5 months of the year, we saw a very strong preference from investors for fixed income over equity. And then in June, we saw that reverse, and we saw twice as many flows into equities as into bond funds. So that was an interesting, pivot that we'd seen in the market, and we think may have started to be pulled out of money market funds. I know we talked earlier about just the record amount of cash on the sidelines in money market funds right now. In the last few weeks, we've saw some fairly substantial outflows, and so that kind of corresponded with some large inflows to equities. So we may see investors starting to kind of dip back into the market. As you know, it maybe not be performance chasing so much as is really just making sure that they're not missing out on the next leg of what this may look like. So again, we've seen investor sentiment change fairly substantially from the beginning of the year, kind of in line with economists' forecasts for a recession in the first half, followed by a recovery in the second. And in some ways, that may have just flipped, right? And so we saw an incredibly strong first half, and not a lot of participation in that, because I think investors were underweight equities to start the year. So we have seen kind of that inflection point where flows are starting to flow back into the risk side of the market. And then within fixed income, I think that since kind of the fourth quarter of last year, flows have really been dominated by the short, the very short duration, the front end of the curve, the cash stepping out through to 1 or 2 years of duration, but really focused on the fixed and the front end of the fixed income curve. We've seen that start to change as well. So we've seen investors add duration, and whether that was specifically for a recession hedge within a portfolio or just opportunistically around yields, we've started to see that preference switch as well. So again, a little bit away from fixed income and into equities, and then within fixed income, away from cash type exposures into kind of that intermediate part of the curve. So yeah, investors are definitely on the move. And I think that you made this point earlier, so I'll just reemphasize it and make it again. It's been so important for so many of the investors that we speak to just be able to be nimble in this type of environment where, the market is moving on so much different news and different data releases. And it feels like, if you miss a day or a week, the entire narrative may have changed. And so, we've had a lot of conversations with investors who have been able to use ETFs to be able to reposition their portfolios and get defensive when they need to, or maybe add a little bit of a risk when they feel like they were under allocated. And I think that that's just going to continue to be important through the second half of the year.
Right, Christy, excellent stuff. Thank you so much for joining us today and for sharing your market outlook and investment ideas for the second half, which is going to be very interesting, I know.
Perfect. Thank you so much for having me.
That was Christy Akulian from BlackRock. So this was the third and final episode in our series of Midyear outlooks and investment ideas for the second half. In the previous 2 episodes, we spoke to experts from State Street and Global X. And in fact, we saw some common investing ideas, common themes in those interviews, including recommendations for a focus on quality, dividend payers, staying invested in equities, but increasing defensive tilt, and some interesting thematic ETFs, including robotics and AI. So now let's recap the tickers that we discussed in this interview and talk about some more ETFs that you could use to implement those ideas. So Christy had mentioned AGG by iShares. It is the iShares core US aggregate bond ETFs, very popular with about 92 billion in assets and very cheap with just 3 basis points expense ratio. And this provides broad exposure to US investment grade bond universe. BND by Vanguard is another ETF which is very popular with more than 94 billion in assets and has the same expense ratio of 3 basis points. For quality ETFs, we talked about QUAL, and we had talked about some more quality ETFs, so I'm not going to repeat them here. SDY, QUS, all excellent options. If you want to take a look at high quality dividend-paying, dividend grower ETFs, we talked about DGRO. It is the iShares Core Dividend Growth ETF, has an expense ratio of 8 basis points and about 24 billion in assets, very popular with investors. Another one which is an excellent choice is VIG. This is the most popular in this space with more than 69 billion in assets and has an expense ratio of 6 basis points. If you want to take a look at low volatility ETFs, the one by iShares is an excellent option. The ticker symbol is USMV. It tends to underperform the broader indexes during very strong bull markets, but holds up relatively well during market declines. If you want to take a look at robotics ETFs, we had already discussed in an episode with Global X, IRBO or BOTZ. Both are excellent options. Thanks for listening. If you like our show, please leave us a rating on iTunes, wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.